Welcome back. You're still tuned into Halftime Report on CNBC-TV18. Let's get to the first stock that we're talking about today. In fact, RPG Life Sciences is doing quite well. That stock is up around 4 to 5 odd percent. It's cooled off to a gain of around 2 odd percent, but it had a solid start with an 8% increase at one point in time on an intraday basis. To talk more about the company, which showed a year-on-year growth but was a bit sluggish sequentially, we have with us Yugal Sikri, who's the MD at the company, joining in now. Mr. Sikri, thanks very much for joining in. If you could just start by talking a little bit about the margin pressure that you've seen Q on Q. I agree that you've seen, an increase on a year-on-year basis, but if you look at your numbers on a sequential basis, there's been a little bit of a sluggishness. Take us through the reason for that. Is there a seasonality element here?
Thank you so much, Ekta, for getting me on your channel. I think you yourself answered. Actually, that is precisely the answer. The quarter four, for us as well as generally in the industry, is much lower than quarter one, quarter two, quarter three. This is what you would see in the last many years, 3, 4, 5 years. And I think it is simply that. Else, on YOY basis, quarter, annual, I think the numbers are on upward trajectory.
Mr. Sikri, good afternoon. Thank you for joining in. So what does this do to your projections? Because for the full year in FY25, you came up with margins of 24.5. So would you expect the number to be as is for FY26 as well? You've earlier maintained that you want to have your margins somewhere around that 26-27% range. Do we see that number going back to that level in FY26?
Yeah, my answer to this question had been very consistent. The upward EBITDA margin trajectory, which we have had in RPG Life Sciences, has been very structural. And it is not happening just 1 year, 2 years. It has been happening for the last 6 years. If I just give you the dimension, it was 10.4, it has moved to 26.4, not even a single year blip, recording about 1,600 basis points increase. And similar reflections are in PBT, 1,840 basis points increase, PAT, 1,380 basis points increase. Therefore, the upward trajectory which has happened is a function of strong cost optimization measures, both at cost of goods level as well as at the OPEX level. And those measures being structural continue, and therefore I don't expect the margin trajectory to be anyway different than what we are seeing so far. Of course, the kind of the curve which has been, the slope of the curve has been, will be a slightly flattish, but the structural measures will continue to drive the EBITDA margin.
Okay. All right. So give us a ballpark guidance that you have for the next fiscal in terms of margins.
Yeah, Ekta, you know that we generally don't give the guidance going forward. I just indicate that the past is the proof. Upward trajectory will continue. We are, of course, pursuing 1,000 crore turnover going forward. That's the most logical next step. And with the improvement in revenue, I think the margin should also improve. At this stage, I must share with you that we have 3 business segments in our company. One is domestic, second is international formulation, and third is the API. We had so far the domestic formulation driving the growth. The international formulations and API, we have taken now 2 solid measures. One is the plant infrastructure modernization, make it approvable by the regulators. In fact, we have got the approval of the TGA and PMDA already for the API plant. And similarly for the formulation plant, modernization has helped us to get the EU approvals. And we have invested close to 140 crore in the 2 plants. Now, with the 3 segments, all domestic formulation, international formulation, API, all the 3 firing, vis-a-vis only domestic formulation firing, I think revenue must accelerate.
Sure.
And the margin should also show the impact in margins.
So, Mr. Sikri, if you could share a breakup of your 3 segments. Now, you mentioned that you are focused domestically, but now with all your 3 engines firing, as you just said, What does that do to your mix? How will the revenue distribution be among the three segments?
Yeah. We have currently 66% coming from the domestic formulation, 20% coming from the international formulation, and the remaining coming from the API. Now, as we go along, the domestic formulation will continue to grow ahead of the market, which has been happening consistently for the last 6 years. International formulation will start contributing more than what it has been contributing today. So therefore, the contribution of the international formulation business is expected to grow better than what it was earlier. And the API also should grow because of the measures which you have taken. As I described, we have modernized the plant, we've got the approvals, we have got the R&D pipeline also under development. Somewhere in late FY26, we should see the new products also coming out in the market. Currently, they are in the various stages of the development. That will add to the margin, the sales improvement and the margin improvement. Plus, I also want to point out to you that we were in debt. We have paid the debt. We have spent 140 crore in modernization of the plant. Today, we are sitting on a healthy cash surplus, which has further got increased. You would have seen the cash surplus is currently 266 crore. And with this, we are actively pursuing the acquisition, inorganic opportunity, and that, depending upon the inorganic opportunity, the contribution of three business segments would finally pan out.
So that's exactly what we wanted to narrow down on, Mr. Sikri. This particular acquisition that you're looking at, you have 266 crores of cash. Can you tell us how much of it do you want to deploy in terms of an acquisition, and which segment are you looking at, domestic, API, or the international space?
Yeah, I think again, important question for us. We are now open to both API and formulation, because we see very strong growth trajectory in both formulations and API. So we are actively scouting the M&A opportunities. As I mentioned earlier, we have actually evaluated, I personally evaluated close to 25 such proposals. But the valuations being crazy, we have not been able to finally succeed. But I think we have now expanded our target from formulations to API as well. And therefore, that should help us to deploy the cash surplus we have generated ourselves. And plus, we have put on the leverage possible. That also gives us the opportunity to target bigger targets.
Right. Thank you, Mr. Sikri, for sparing time and joining us today. Wish you good luck for the rest of the year as well. That is the management of RPG Life. Moving on then, Max Healthcare